Hey, this is Kehinde Fawumi. You're listening to the Unleash Your Genius podcast. You have to understand what good and bad debt is. Good debt is when you incur the debt on an asset that is able to pay off the debt and still pay you a lot more profit on top of it. That is good debt. Bad debt is, of course, when you get a debt that does not bring you anything. So you get a loan to buy a car that you drive around to look good. So people now think you're rich. Does not pay you anything. It's just money that goes away. That is very bad debt. So what you want to think about is good debt. And you need to know that to be able to do the big transactions, you need a form of debt. It's almost unavoidable when you're starting. Of course, if you want to do the big transactions, you do your due diligence on your investments. You combine your own savings, what you have, with a level of credits and debt, put that together, do the big thing, pay back as quick as possible so that now you can enjoy the profits of what you have. At the end of the day, what matters is your net worth. Your net worth, and you see it's the total of your assets minus the total of your liabilities. In some of the comment sections, we're going to go into acquiring businesses, because some people are afraid to write that you can earn 50 million in 3 years, but you can. You just need to acquire a business that is worth that much. I mean, come on, guys. If you acquire a business in 2 months and you can, a business that is worth $5 million, and you own that business, you're worth that amount. Of course, I understand that you need to take some credits. You may need to. And I will tell you how you can acquire a business without taking a credit and without using any of your money. This is getting more interesting. And how you can do that. No credit, no money from you. So we're thinking about how to hack wealth, right? It's only if you don't know how to do transactions, that's when you think, okay, these things are far reaching, they're outside of my reach, but these things are possible. Okay, let's focus on stocks. Ground rules for stock investments, basically, or buying shares with companies and all. Why I buy stocks essentially is of course the first thing because of the profits, but also because of the vision of the companies I'm invested in. I am heavily invested in Tesla because I trust that that's the future of clean energy, renewable energy, solar energy, but also electric cars, and Mars. What can be better than that? I believe in the vision, and Elon Musk has been amazing track records of success. So by doing that, I also make impacts, footprints through that company. Risk a little and gain a lot. There will be a level of risk, there will be some uncertainty levels. You just have to live with that. Diversify. And by that, I mean that not only that you should not invest only in one company, but also don't invest in one type. So for example, do a bit of cryptocurrencies, do a bit of shares, do a bit of funds, index funds. And I'd explain what I mean by that in a moment. So diversify where your investment goes in and never stop learning. The more you know, the more propensity you have to be profitable in your investment. And how do you make money from stocks? Right now, stocks are still on sale, and that's why I talk about stocks now. The point is that at the moment, you can get in on a low. So most of the stocks are low in price at the moment because of the COVID situation that affected people's level of trust. People lost a lot of their jobs, and the markets came crashing. Now you can get in on a low and wait 1 year, 6 months down the line, in some cases for me, 2 months, cash out, and you're good. It also depends on how much margin you want to set. For example, do I want to only make a profit of 50%, or do I want to go as far as 1,000%? If the higher the gain, the longer you may need to stay in the market. Or but the lower, if you just want to get 10% and get it off, then do it. It may be 3 days, you get the 10% and get off, and don't be greedy, because when you now want, like, you now think that, okay, now 10% is still going high, let me wait till it gets to 20%, then it goes down again, and then you're unsure what to do again. Set your goal from the onset, cash out once you reach your goal, re-strategize, get in again, or in my preferred approach, stay in for a longer term, because now you're getting in on a safe note, because the markets are low. Now you get money because the stocks would appreciate in value, and that means that your money would appreciate. Dividends, you get dividends. For you to get, not all companies pay dividends. Many of the companies pay you a level of dividend. At the moment, I must warn you that the dividend payments are low, because of course the companies are struggling. That's also why the stock prices are low, right? But what you want to do is get in now, so that once the dividends rise again, you're able to benefit from that. Now, you have to see this as a journey. It's a journey. Don't expect to make all the gains in 1 week. That's not how this works. So please take note that this is a journey. Get in now, and then in the near future, you would be able to benefit from it. So blue chip stocks are stocks that pay high dividends, and that's what you want to go for if you want to, if you're interested in dividend payments. Dividends are good for your passive income on a monthly basis. It just comes in, you don't have to do anything. That's what dividends does for you. My advice is that go for stocks that are paying 7% dividends per share, at least 7% higher. That's what I go for. Go for blue chip stocks if you want to benefit from dividends. Tesla does not pay dividend, for example. Facebook does not pay dividend, for example. Just giving examples. But so the only reason you would invest in that is because of the future outlook of those shares. Yeah, stocks have always endured a major economic setback. So don't be afraid that whether will it bounce back, will it stay here forever? No, it will not stay here forever. We know that for decades, that it will always bounce back, because it always does.